as with everything else, there has to be some sort of beginning to partnerships. When we put a partnership together, when two people go into business together and form a partnership, they generally speaking don't recognize any gain or loss during the formation of that partnership, because all we're doing is putting assets, we'll assume for the sake of convenience here, maybe cash, that has already been taxed, and combining it with other assets from the other partner, right? Those assets have already been taxed, or that has already been taxed as income. Most common way to form a partnership is for two or more partners or entities, so two companies can also form a partnership, to contribute cash, property, or services in exchange for a partnership interest. So cash is probably conceptually the easiest to understand. So Ange and I go into business together and we're gonna form a partnership. He puts in $5,000, I put in $5,000. Now the partnership has $10,000, right? There's no tax on that. All we've done, because that $5,000 from each of us has already been taxed as income. So there's no taxable event that has occurred when we form that partnership using that cash. Now maybe instead of cash, we contribute property. So Ange puts in $5,000 and I put in a van that's worth $5,000, okay, that has a fair market value of $5,000. We've each contributed property worth $5,000, so now our business, our partnership is worth $10,000 together. But still, at that point, no gain or loss has occurred. Also, what we could do is contribute services. So Ange puts in $5,000, but I don't have any money, I'm broke, I don't have a van or anything else, but what I'm gonna do is I'm gonna contribute my work toward the partnership. So let's say we put together a pie baking business. Have I mentioned pies before? Yes. I use that example.
It's always baking.
It's always baking. All right, so we have a pie baking business, and I've got some great recipes for pie, and I'm really good at baking pies, but I don't have any money. Well, Ange knows that I am a really good at baking pies, but he's got some money, but he wants to go in, he thinks that we can make some money doing this together. So he puts in $5,000. I don't have any money, but I have my expertise. So what I'm gonna do is I'm gonna be the one that bakes the pies. And the value of my services, though, is going to be what my contribution is to that partnership. So I'm contributing my services to that partnership. So those are the three main ways that people can form a partnership. Here we got Jason and Spence. They have a lawn care and landscaping partnership. Each of them contribute $25,000. And in exchange for that $25,000, they receive a 50% interest. So now each of them owns half of that partnership. No gain or loss is recognized in this transaction. All they've done is they've moved $25,000 from one pot into another pot, right? So nothing has really happened at that point. Now we're going to talk a little bit about basis. It says here, the concept of basis is really important. There are two types of basis. There is outside basis and inside basis. So, outside basis is the basis of the partnership interest in the hands of the partner. Inside basis is the partner's share of the basis of the individual assets in the partnership. So, inside it's the assets, well, the partner's share. So if we're 50% partners and we have assets worth $50,000, then Ange's inside basis is $25,000 and mine is $25,000. But our outside basis may be different from what that inside basis is. So again, this is the basis of partnership assets to each partner. Oh inside, they have those, I think I have those backwards. See, even I get this mixed up. No. Another way you can kind of think about this is, so the outside basis, if I were to sell my share of the partnership, this is the basis that I would use. Okay? I'm not gonna use the inside basis for that.
Why not?
Because the inside basis does not include other transactions that are included here. Okay, so if we make contributions to the partnership, or I take a distribution, it's not included in that outside basis calculation. And when we're taking a distribution, essentially what we're doing is just we're reducing our value in that partnership, right? We're taking money out that we've already put in, and that's what affects our outside basis. And we'll go through some more examples here of it. All right, so when a partner contributes property to a partnership, the basis of the property, so my $5,000 van, carries over to the partnership and adds to our inside basis. So my $5,000 van that was contributed, and Andrew's $5,000 of cash, because its value is $5,000, contributes to the inside basis of the partnership. Okay? The partner's basis increases by the basis of property contributed, which is our outside basis. Okay? So in this case, it's going to be the same. My inside basis, mine and Angie's inside basis and outside basis at this point in time is going to be the same, $5,000 each, because the basis to the partnership is $5,000 and our contribution was $5,000 each. So right now they're the same, but they can be different and will change over time. Concept is known as basis in, basis out. Let's look at an example. So Bart and Alan form an LLC to construct personal residences. Each of them is a 50% partner in sharing income and loss items. Bart contributes the following assets to the partnership. So the basis to the partnership carries over, the basis to the partner carries over to the partnership. But that's not necessarily the fair market value of what was contributed. Okay, so that's where you may get a difference as well. So this is what, let's see, Bart contributed land and equipment. His basis in the land was $55,000. That means maybe he bought it for $55,000 5 years ago. But right now it's worth $100,000. Okay? The basis to the partnership in this case is $55,000 because that's going to carry over. He contributed equipment that has a basis of $35,000 but a fair market value of $50,000. Okay? So the basis to the partnership, like I said, is going to carry over. So this is Bart's contribution. And then Alan is contributing $90,000 of cash. I'm assuming this is basis and fair market value. They didn't put a title on that, but. So cash, obviously cash is gonna have the same value, fair market value and basis. Office equipment that has a basis of $30,000, but a fair market value of $40,000. And a truck that has a basis to him of $5,000, but a fair market value of $20,000. So you can see the basis to the partnership of the items that Alan contributed is $125,000, because this is what carries over. But the basis to Alan is the $150,000.
But I thought that was fair market value.
So this is a 50. Yes, this is fair market value. Did I say that backwards?
Yeah. Well, no, you said You said that was Bart's, you said the left was Bart's, and you said the right was Alan's.
Oh, I'm sorry. So this is, I'm assuming, because they didn't put titles up here,
Right.
that this is
Oh,
basis and fair market value. But you'll see that their ownership percentage is based on the fair market value of the items that they contribute.
Okay.
But the basis of the items in the partnership isn't the same as that, because it's the basis that's gonna carry over, not the fair market value.
Not the percentage.
Well, in this case, so they're 50-50, cause the total, they each contributed 150.
Right.
So, excuse me, so the equipment is 30 years, and then both of them is 35. What you supposed to know for the fair value?
You'd probably get an appraisal. You'd wanna get it appraised.
Yeah, because because somebody put together, and then after somebody separate, because up is 35, and then over there is 50,000.
So obviously Bart has been using this equipment in his business. He's got his own business over here. Alan has his own business over here, and they decide to go into business together. Each of them has equipment on their books, that they've had, and they've been depreciating it. So that would be the basis of that equipment, whatever the book value of that equipment is. But then when they form a partnership together, they're gonna get those assets appraised to find out what they're worth. And they both wanna be able to contribute, because they wanna be 50-50 partners, they wanna contribute assets with the same fair market value.
But what if they're not?
Then their partnership,
Will be a different percentage?
yeah,
Okay.
unless they came to some agreement that they were still gonna be 50-50.
Okay.
But normally speaking, yes, so the fair market value of whatever they contribute is gonna determine what their ownership percentage is, but you can see that the basis of each of these items, the basis of the partnership, are not the same, just the fair market value, right? So Bart's outside basis of the partnership interest, here's Bart, is 90,000. The sum of the contributed assets basis. Alan's outside basis in his partnership interest is 125,000. The sum of his contributed assets basis. But their inside basis is gonna be 150 and 150. Okay? His basis is only 90,000 while Alan's is 125, yet both own 50%. This happens because Bart's contributed assets had higher unrecognized gains. There were no gain, he's contributing them at this time. So if he sold these, think about this. So if let's say Bart sold this equipment for $50,000 and contributed the cash of $50,000 to the partnership, then he would have to recognize a gain of $15,000 at that time, right? Because he sold it, there's a gain there, and then he contributed the cash. He doesn't have to recognize a gain right now. At some point though, he is gonna have to recognize a gain. Just not at this point. So both own 50%. Bart's contributed assets had higher unrecognized gains. That's what they're talking about there with the unrecognized gains. If he were to sell his partnership interest for its fair market value of $150,000, he would recognize a $60,000 gain. So at that point, so if he contributes them, so he's not gonna avoid having to recognize that gain, he's just gonna delay it, okay? Is that,
That's correct.
okay,
So basically, the outside basis is your basis. The
Yeah.
inside basis is the fair market value of that basis.
Which the outside basis is the fair market value, the inside basis is your basis,
No,
right? I
so
just said that.
outside basis is gonna be the basis
yeah,
of the assets that you contributed.
Oh,
yep, and that's what you paid or whatever.
Right,
And then the inside basis is the fair market value of those assets.
yes,
Okay.
yes.
So the inside basis basically, sorry, is the percentage, is your percentage?
Your
of the
ownership
partner.
percentage.
Okay.
And that's going to be important because when we recognize gain and loss, that means that each of these guys at 50% is going to each recognize 50% of the income, 50% of the expenses, and all of those separately stated items.
Okay.
Okay, so when we're talking about, so in this case, we're worried about the assets at this point. But eventually, that ownership percentage is important when we talk about how we're gonna report the income,
Okay,
okay, as we go on.
okay.
Alright.
I just wanted to
I-
clarify that my brain was connecting outside
No,
basis
I know,
is
so-
your basis, inside basis is fair market value.
I'm glad you did, cause I wasn't, you see I had it backwards.
Thank you.
I
So,
think I have it right.
okay,
Yes.
okay,
It's easy to
so,
get them confused. You can
Yeah.
see I'm,
so the gains, so like if Bart, is that his name? If Bart were to sell his, and his was actually, I mean, obviously, if it weren't 50-50, so like, let's say Bart owned, it was 60-40,
mhm.
whatever those numbers would be. If he sold his at fair market value, would Alan take 40% of that gain, or would just Bart?
No, just Bart.
Just
When you're
Bart.
selling, if he's selling his interest, it's only
Okay.
going to affect Bart.
Okay.
Yeah.
Do they
But
split
when- but if it's
that
60
for gains like that though, otherwise?
But as the partnership progress, as you know, it goes through its life cycle, and we have income and expenses that have to be reported, it would be reported in a 60-40.
Okay, so
Percentage.
just the income expenses?
Yeah,
Okay,
yeah. But so his gain, like, and, I mean, when you step back and kind of think about it, it makes perfect sense, because otherwise, if he were able to contribute items that have increased in value, and then this was his basis when he sold his partnership interest, he's just avoided $60,000 of taxable gain simply by contributing it to a partnership, right?
but if they, so I guess my question is, if they collectively decided to sell equipment
Mhm.
for their company, they're staying as a company, they collectively have decided to sell a piece of equipment that they had a gain on.
Yes.
They
then
would
it's-
split that
then it's
60-40?
50-50. Based on their partnership.
Okay,
Yep, exactly. So, and that's gonna be reported on the K1
okay,
as they would have their own form 4797 where they report all of that for assets, depreciable assets.
got it,
And then, yes, it would be split up 60-40 based on their
percentage,
percentage ownership.
Okay.
Yes,
if they
yes.
sold anything with the gain.
if they, yes,
Okay.
individual assets.
Got
Yep.
it.
Yep, let's see. I know, it's complex.
It's just a lot of words.
You guys,
It is a lot of words. So partner's basis in the partnership interest is the sum of any money contributed plus the adjusted basis of property contributed. So, let's see, sum of money plus property contributed. Let's look at this examples here and see if this says it all. Dave and Alyssa form a law partnership. Dave gave $100,000 cash to the partnership, and Alyssa gave $100,000 of unrealized accounts receivable from her cash basis sole proprietorship. So they both had law firms, they go into business together. Dave has $100,000, or Alyssa has, Dave has $100,000 of cash. Alyssa has accounts receivable, so she's got clients that owe her $100,000. I don't know, Dave might wanna reassess whether he wants to go into partnership with Alyssa if she's not able to collect. But anyway, so if they collect it, it's worth $100,000, but if they don't collect it, it's worth $0, right? So, the basis of the partnership interest to each partner, so Dave's easy. Dave's partnership basis is $100,000, but Alyssa's is $0. She has no, because they haven't collected it. As they collect those accounts receivable, her basis will increase.
Question, because you said services are part of this. So,
Yes,
seeing that she has $100,000 in accounts receivable
Mhm.
that she hasn't collected yet. Could we substitute service for that in that event until it's collected, or how could that work?
So instead, it's in order to get basis, you
Yeah,
mean?
Yeah,
Well,
have inside basis.
yeah, she can. What's gonna happen, and what you'll see here with the services, is when you contribute services, in order to increase your basis, you have to then have reportable income. So even though you don't get the cash, you're gonna report it as income and pay tax on it. I mean, that's kind of the concept behind all of this stuff is, have you already paid taxes on it, right? If you haven't paid taxes on it yet, they're gonna tax it. Like, so the services, because when she sells her partnership base, let's say she contributes $100,000 of services. And then she sells her partnership interest for $200,000. Unless she's paid tax on that $100,000 of services, she cannot claim the $100,000 as a basis because her gain would be just that $100,000. So she's got, in order to get the benefit of that smaller gain from the sale, she has to have paid tax on that $100,000, that original $100,000, in the form of services. Or if she contributed cash, or if they collected the accounts receivable. Because when they collect the accounts receivable, they're gonna pay tax on it, right? But they're each gonna have.
So basically, no. Services has to stay in its lane and accounts receivable has to stay in its lane.
Yeah, I mean, it's best if it does. Either way, they're gonna get you either way.
Okay.
Okay.
So if we set this up like Bart and Almonds, Dave's basis would be $100,000 with a fair market value of $100,000,
Yes. because
and then
cash.
hers would be zero basis with $100,000 fair market value.
Well, actually, it's yes,
Okay.
yes.
So as they
Sort of.
collect that accounts receivable, does that fair market value go down as her basis increases?
No, because ideally what's happening is it's cash that's coming in. So we've got, so the cash part is going to then increase. As that fair market value decreases, the cash is gonna increase. So it's gonna balance out.
So the,
So instead of, we're just replacing one asset for another.
right.
We're replacing we're replacing
AR
accounts
with cash.
receivable for cash,
Right.
with cash. So,
That kind of answered my question.
okay,
I feel like we're putting the wagon before the horse. We're
yeah,
just-
you're probably getting a little more complex than you need to.
Well, but like
But-
if you scroll up to
Yeah.
the Dave and Bart,
Mhm.
where it separated it out,
Yeah.
right there.
Yeah.
Where it says basic fair market value. So if we did that, instead of it saying undeveloped land and equipment, it would say Dave and, what's her name? I don't know.
Alyssa.
Alyssa, okay? So
Yeah.
Dave's basis is $100,000 and his
Mhm.
fair market value is $100,000.
Right,
Her basis is zero
Right.
and her fair market value is $100,000.
yeah.
So as they collect that money,
As they collect that money,
would the fair market value decrease?
the fair market value of the accounts receivable, yes.
Yes, as the basis increased.
As the basis,
Okay.
as her basis increased. Because
Got
what's
it.
gonna happen is, so we got $100,000 of accounts receivable
Mm-hmm.
and zero of cash. We get $20,000 cash in, we're gonna have 20,000 of cash and 80,000 of accounts receivable. So it's still
Okay.
gonna total that $100,000,
Okay,
just gonna be two different assets at that point.
got it. And then her basis would increase at that point by the $20,000 that was paid.
Yes,
Okay,
yes,
that's where I was going with that. In
Yeah.
my brain, I was like,
yep,
wait a second.
alright. So, more about basis. So basis in, basis out, so that essentially is what we're talking about here is when it's basis in, basis out is this whole concept of, okay, the basis to me was this, now the basis to the partnership is the same, right? So I'm not gonna avoid any gain on that when the partnership sells it. So the assets contributed to the partnership must have a tax basis for various purposes, so depreciation, so we're gonna be, the partnership's gonna be depreciating these, so we've gotta have a basis for, those purposes. Also, if we sell that asset, we've gotta have a basis for determining what our gain or loss is on that asset. Partnership steps into the shoes of the partner, okay? So the basis in the hands of the partnership, same as the basis in the hands of the partner, therefore, they said that like 6 different ways. Okay, so we have this concept of tax basis balance sheet, so that's different from a financial statement balance sheet. So this is gonna be based on tax basis, not financial accounting basis. And as they mention here, many small partnerships, instead of, because they're not really required to follow GAAP, a lot of them, they'll just use tax basis balance sheets and accounting. Because it's a lot easier to then hand that information over to your accountant when they prepare your taxes. They don't have to then convert it from one basis to another. All right, so here we've got, this is Bart and Alan again. This is their tax basis balance sheet after everything's been contributed. So cash, which was contributed by Alan, I think it was, Bart, okay. $35,000 of equipment, so that was, whoever that was. Office equipment, $30,000. Truck, was there a truck? I don't remember a truck. Oh, yeah, there was a truck. So Alan contributed a truck. So now this is the basis to the partnership. And then the undeveloped land of $55,000. And this is their capital accounts within the partnership. This is going to, so their equity in the partnership, okay? Each of them, and it is going to, it would always be separated there between, so you're not gonna have just one general equity account. It's gonna be separated by how much each partner has. For depreciable assets, partnership will assume the depreciation schedule of the partner at the point of the contribution. So it just continues. So if it's already been fully depreciated, you're not gonna depreciate it anymore. If you had, you've taken 3 years of makers on it, you're gonna start it at year 4 when it gets contributed, that sort of thing. It's as though it just continues on, okay? If it's a personal use asset that's contributed for business use, the partnership's basis in the asset is gonna be the lower of either the partner's cost or the fair market value of the asset. So whichever is lowest between those two. So cost, of course, whatever they paid for, because it's an item that hasn't been depreciated if it was personally used, right? Example of that, Jose contributed a piece of equipment to JW's partnership. The cost of the equipment, and this is important, so he contributed it on March 1st. So he had 2 months before he contributed it. That's when we see this, that's what they're apportioning it between when it was personal and when it was belonged to the partnership. It was $20,000. Year 2022 was the 3rd year of depreciation. Depreciation for the equipment for 2022 would be calculated like this. So for his Schedule C, he's gonna take 2 months of that depreciation, what it would be for the 3rd year, right? The partnership is gonna get the other 10 months of depreciation, okay? So it's as though it just continues, no stopping there. He also contributed a truck that he had used personally for 4 years. The truck cost him $28,000, but its current fair market value is $8,300. Therefore, the basis to the partnership is $8,300. That's a little bit more realistic than the previous example where the equipment increased in value. Yeah, that's hardly ever gonna happen, right? But so whichever is lowest of those, which paid for it, or what his fair market value is. And again, you'd probably get an appraisal or something for a truck, Kelly Blue Book, something like that to determine.
Isn't it only taxable up to like what we just learned in the other chapter? For the truck for a commercial vehicle,
Well, you mean the luxury auto
Yeah, there we
limits? That if it's sold,
Oh, okay.
yeah. If it's, or I'm sorry, no, if it's purchased, then yeah, it's limited to a certain amount of depreciation depending upon, so yeah, you would, if you are if you're still depreciating that, you'd have to carry over, if you were still, had those limits, you'd still have to carry those over
Okay.
to the partnership.
So once it's contributed, you still use like the original cost and then just like depreciate it from that original, what is it, like 20,000? You don't like start over with like what the amount was
No, you,
like,
well,
in it? Does that
you,
make sense?
you start out with what it's, if it was personal use, you start out with what its fair market value, whatever's lower between this one and this one. If it was a personal use asset.
So
if
if the fair market value was lower than what, like, the cost minus the depreciation was, you would use the fair market value instead and then depreciate
Yeah, but in this
from there?
case, you wouldn't have any depreciation because it was personal use. You wouldn't have depreciated
For
it.
like Jose's,
Up here,
yeah, for like that one.
so for this one, because it's business use, then whatever you're just gonna transfer it as is into the partnership.
Oh, so he had it for business use before he contributed to the
Yes.
partnership?
Yep.
Oh, okay, I thought
Yep.
that was personal and then.
Yep.
Okay, I
Yep, that's the
gotcha.
difference between those two.
Okay, I
Yep.
gotcha.
Alright. So the basis carries over if it's, so everything just carries over if it was used for business purposes. What are we talking about here, holding periods? I don't know why my brain's not working right now.
I feel like that's our fault, sorry.
What's that?
I feel like that's our fault, we're asking a lot of questions right now.
That's right. My brain back into gear here. So usually, so the holding period of the partnership interest would include the holding period for the partner for 1231 and capital assets contributed. If it's an ordinary asset, then the holding period begins on the date of the transfer. But remember, the holding period of an ordinary asset doesn't, I don't wanna say it doesn't matter, but for tax purposes, it's not gonna make any difference because it's always treated like a short term. Like if you're, so for inventory or accounts receivable, you know, the holding period makes a difference with regard to taxes if there's a difference in tax rate between long-term and short-term. Right, so, but if it's a 1231 asset or a capital asset contributed, then whatever the holding period was for the individual, that's gonna be the holding period for the partnership. So here's an example of that. So Casey contributed a building and inventory. So basis, fair market value, so his outside basis, inside basis. These were the dates that they were purchased originally. So the building is a 1231 asset, has $175,000 basis to CWS, so that's the new partnership there. Has a long-term holding period because he purchased it in 2013. Inventory, however, is an ordinary asset, so its basis is $50,000, but it's gonna have a short-term holding period. So when they sell it, it's gonna be taxed at ordinary rates, which it would anyway. I mean, whether it was, regardless of how long it was held. Okay, so 1231 assets, business assets and capital assets are going to carry over the holding period as well. But the inventory and accounts receivable, regardless of how long you've held it, is going to be considered short term. Okay? Okay, contribution of services. So, non-recognition of gain does not apply when a partner receives a partnership interest in exchange for services. When forming a partnership, one or more partners will frequently invest capital and other partners will perform services. The partner that is providing services will recognize income to the extent of the fair market value of their partnership interest. So in our example where Ange and I went into partnership together, we determined that if we're gonna be 50-50 and he's contributing $5,000 and I'm contributing services, then naturally the fair market value of my services is $5,000, right? Because that's how the math works, right? So, Russell, Kevin, and David form a partnership. Russell and Kevin are wealthy investors, good for them. David is an expert construction contractor. Russell contributes a 20-acre parcel of land. Kevin contributes cash. Okay, so the parcel of land has a basis of $200,000, but a fair market value of $300,000. Kevin's cash, of course, is $300,000. David agrees to perform all the work to develop the land into a high-end subdivision. So this is the ownership percentage that they agreed upon, 30, 30, and 40. So David is going to recognize $240,000 of income in the year of formation. It's as though he's contributed an asset, well, 240, how do they get 240? 40%.
Times his percentage.
Yeah, 40 times, so the 600, this is the total fair market value here. We're gonna take 40%, yeah, of that 600,000 is his 40% interest. So he's going to pay tax on $240,000.
So
Yeah.
if the fair value market is lower, that's the basis. So
Yes.
it's going to take the basis.
Yes, yeah, so if this was, so if he's at 40%, if this was $100,000, he would then recognize $40,000 of income.
So, if he doesn't have basis, how, like, why does he still have to pay tax?
This gives him basis. When he pays tax on that, now his basis is $240,000
For like the next year?
forever. Well, not forever, until it changes.
So then would theirs also decrease?
No. Theirs is still gonna stay at the outside base is at 200 and 300, and then the inside at 300 and 300.
Because that's what they have, that's what they put in.
Yes,
He is saying like, I'm gonna do this,
yes,
so he has to do it.
he has to do it. And once he pays tax on it, that's when his basis will be
Not
adjusted.
even when he's made it, when he's
Right,
received the income.
once he's paid,
and paid
once
the
he's
tax.
paid tax on it,
Gotcha.
right? But he won't receive that as income, he doesn't get this cash.
Okay, it goes to the company, right?
When they bill for it, yes, it's gonna go into the partnership.
So then where does that come from?
The 240,000 or
Yeah.
the tax on the 240,000
Like,
or,
the 240,000 itself, like, if it's his services, but like, he's not receiving cash,
how did they figure out the 240 or?
like, no.
I guess-
There's no
Where
cash,
is-
Yeah.
there's no cash. They're not gonna get $240,000.
So is it from, I guess she's asking like, is it from the NOI,
NOI.
net operating income? Like, is it from the income? Where does?
It's not gonna, there's not gonna be any cash. He's gonna pay tax on, instead of cash, he's getting a partnership interest that's worth $240,000.
So he'll earn income from the partnership?
If that's in the agreement, yeah. But he's gonna pay, so the 240,000 is not going to come to him in cash.
Right.
He's getting, like I said, he's getting paid now if he goes and sells his partnership ownership, he gets, say he sells it for $250,000. He's only gonna have to pay tax at that point on $10,000. Because he already paid tax on the $240,000.
Okay, so I guess what she's asking is now, or if she's not, what I'm asking is,
Mhm. Yeah.
so off of what they just built, off
Mhm.
the land, cash, and his services, they've made X amount of money. 40% of that,
Yes, so he's gonna, well,
Okay.
40% of that income and expense will be attributed to him on the K1,
okay.
based on his ownership percentage. Is that your question, Shelby? He's not gonna get
I'm not really
240.
sure how else to ask it right now though, so we can
Okay.
move on and
Okay.
we can try and
I mean,
figure it out.
he is not gonna get $240,000. Well, I mean, he might, but they're not going to pay him $240,000 in cash. Instead, they're giving him a partnership interest. He's getting a partnership interest that's worth $240,000. But he is gonna have to pay tax on it. He doesn't get it for free. Yeah,
So would the other people report their percentage of the 600,000 as their income?
no. Nope, because they've already put it in. They've relinquished their portion. They're not contributing services. They're contributing other items that have already been taxed.
So
Those
then-
services haven't been taxed yet, at this point that they're gonna be taxed.
So whatever they report on the K1 individually goes back to their individual return.
Yes, and
Okay.
it's gonna be in this percentage.
Right, okay.
So if they make $100,000 of income, and that doesn't mean that they're receiving $100,000, by the way.
Right.
It's just $100,000 of net income. Russell's gonna report 30,000, Kevin's gonna report 30,000, David's gonna report 40,000 of income. Once that K1 is, once the partnership is making money. Yeah. But, and the basis, again, basis is important for when we're gonna sell this, our share of the partnership. It's also important, and we'll talk about it in a little bit, with regard to distributions. Whether or not our distribution, money that we take out, is taxed or not. Okay, but we'll get to that. I won't.
So, because if you have basis, so you're supposed to have loss and gain. If you don't have it, you can have loss and gain.
If you don't have any basis, yes, you can't. It all comes back to, has that already been taxed? Has that income, like I said, they're not gonna pay tax on this because what they contributed, they spent the money, Kevin earned that $300,000 somehow, and it's already been taxed. In a perfect world, maybe he was lucky enough to inherit it, I don't know, and he didn't pay tax on it, but conceptually, that $300,000, when he got it, he had to pay tax on it. When he puts it into the partnership, he doesn't have to pay tax on it again. But David has never paid tax on his services. If he were to, if instead of contributing the $240,000 of services, he said to them, pay me $240,000 and then I'll give you the cash. When he gets that $240,000, he's gonna have to pay tax on it because it's income, it's wages, right? But then when he contributes it to the partnership, he's not gonna have to pay tax on it at that point because he's already paid tax on it. Okay?
It's okay.
Okay. That will get even more complicated.
It's okay.
So, contributed property with liabilities. Sometimes people will contribute, maybe they'll contribute a building that has a mortgage on it. So my building is worth $100,000, but I've got a $50,000 mortgage on it. And the mortgage is gonna be transferred then to the partnership. So, when the partnership assumes the partner's liability, if the partner is released from that liability, they're treated as though they received money from the partnership. It's as though they got paid. Because now they don't have the debt anymore. They've been relieved of that debt. This reduces their partnership basis. If other partners assume a portion of the liability, so you're gonna spread, now the partnership has this $50,000 liability, and if we've got 5 partners, equal partners, each of them is now responsible equally for that liability, their portion, their basis is actually gonna increase, but my relief from debt is going to decrease my basis, but then if I'm getting ahead of myself here. The example will help to clarify this. So, partner who is released from liability is treated as though they received money from the partnership. Because, I mean, think about it, if I give the partnership a $100,000 building, but I have $50,000 of debt on it. Now the partnership's gonna pay that $50,000 of debt. If the partnership gave me $50,000 to then pay off the debt, I'm $50,000 richer, right? I no longer have, I'm relieved of having to pay that. It's like income. Every time you are relieved of a liability, it's the same as income, right? A penny saved is a penny earned. Actually, it's more than a penny earned because, or actually, yes, because taxes. If you earn it, they're gonna tax it. If you save it, they're not gonna tax it. If the other partners assume a portion of the liability, they're treated as making a money contribution that increases their basis. So here's a calculation. We've got four partners. Here are their beginning bases. Angie contributes an office building to a newly formed partnership for in exchange for a 25% interest. The building has a $300,000 fair market value and a $160,000 basis, but it's also subject to a $100,000 mortgage. The partnership is going to assume that $100,000 mortgage. So each of the four partners is going to get an increase in basis of $25,000 because they're all 25% partners, but Angie's going to have to decrease her basis by the amount of debt that is relieved. So Angie's basis is $85,000, but Maria, Bess, and Kylie, theirs is $225,000. Which means if they sell this partnership, Angie's gonna recognize more of a gain, right? Because her basis is low, so.
So why does Maria, Bess, and Kylie have a beginning basis of 200 versus the 160?
Because they contributed $200,000 of cash. Angie, remember the basis carries over if you contribute property. The basis of this building was $160,000. Okay, so, but they agreed in the partnership agreement. They're agreeing that it's 25% apiece. So that can be that can be different than the basis of the property that you contribute. You may have a different ownership percentage. But see, if think about it though, she actually is contributing $200,000 because it's worth $300,000, and it's got $100,000 of debt against it. So it is worth $200,000 to the partnership, the fair market value of it. Like if they sold it right now, they'd get $300,000 and then they'd pay off the debt of $100,000. Does that make sense?
It does, but what's the fair market value then? Like, this is the basis of everybody, right?
Mm-hmm.
So what's the fair market value of everybody?
Well, in these cases, it's good. These are gonna be $200,000 because this is cash.
Right.
Cash is always gonna be the same. Angie's,
300,000.
well, it's gonna be $300,000 minus the $100,000.
Okay.
Yeah, so that'll be her inside basis.
Okay.
But for purposes of her outside basis, we're gonna add, she's getting relieved of this $100,000 of debt. She no longer has to pay it. Now everybody else is gonna share in it equally.
Well, she still has to pay 25,000.
She does, which is why her basis is gonna be increased by the 25,000. So when she sells, she won't have to pay tax on the 25,000.
Oh, okay.
Mm-hmm. But it's also then gonna be decreased by 100,000 because she's being relieved of that amount of debt. Okay? Basis can never go below zero.
Yeah.
Okay? So that makes life a little bit easier, right? But what happens when you do a calculation and it's below zero is now you're gonna have to claim income, taxable income. That's the remedy for any basis that starts to go below zero is you claim taxable income, because every time you claim taxable income from the partnership, it increases your basis. Okay, and you'll see that as we talk about it, one of the sections here that we talk about what affects basis as it goes along. Remember, we're just talking about the beginning basis right now. Okay, So if the release of a liability causes the basis to become negative, the contributing partner must recognize a gain. So she'll have to pay tax on it. So now, let's say that the basis of that building, instead of 160,000, is 45,000. So it's obviously, well, I mean, it could be, if she used it in another business, that's entirely possible. So in this case, we're gonna start with the 45. She still gets to add the 25 to her basis. We're gonna subtract the 100,000. Now she's in the whole $30,000. In order to bring this up to zero, she's gonna now have to pay tax on $30,000. Because really, her economic benefit was $30,000, right? Because she was released from $100,000 of debt, but the total of her assets was the 75,000. I mean, this total of what she contributed was 75. That's 75? No, 70,000.
So then for her to increase her basis again, she would have to like either contribute like cash or like equipment or something to.
You could contribute more, exactly. So if she didn't like this idea of, okay, now I'm gonna have to pay tax on $30,000 of income that I don't have, she could contribute $30,000. If she's got 30,000, then she could probably pay the tax on the 30,000, but that's beside the point. Or she could contribute other items that have a basis of at least 30,000 to bring that back up to zero. Okay? The only time a partner recognizes gain on a partnership formation is when they contribute services or when the partnership assumes a partner's liability in excess of basis. Those are the only two instances where that happens. Yeah.
So comparing this one to the last one where the one guy contributed the services. So when he contributed the services, his basis went up once he completed those services?
Yes.
So he had to pay taxes on the income even though he didn't receive it. But in the other one, the basis went down, but then she paid taxes on the 30,000 that she didn't receive? Is that
So,
right?
because she got a release of liability of 100,000. Because now she doesn't have to pay the $100,000, which is the same as receiving $100,000, even though it doesn't feel the same as receiving $100,000. It's essentially the same economic effect. Yeah.
So for me, it's very easy. Here is asset, and the second one is liability. Like account payable, here I can think so for maybe experience. Experience, you don't have a base, you don't have money, you don't have a value for your experience.
Right.
So you're supposed to evaluate how much you can make. And this one, somebody can fix like a liability and like an income, like a tax is supposed to pay for it. Man, the second example, you have liability, you have a value. It's very different.
Yeah.
So this one, sometimes partnership don't want you can bring this value for zero because you can bring half and then you can keep half. Because if it's too higher, it can have impact for the company. I think so.
Yeah.
Because here she have minus 30. So this one don't make the company good. Here she's have minus 30,000.
Right. But for the company, it doesn't really, in this case, it really doesn't make any, I suppose it makes a difference to the company in that they've assumed, from the company's perspective, they've assumed her debt.
Yeah.
Yeah, and she's been relieved of her debt, and so now they owe it, but she's given them 70,000, but they've given her 100,000. 100,000 of value.
Yeah.
Yeah. Is that
Yeah. It's
summary?
very-
Yeah. Let's see. Okay, So that's when we form a partnership. I'm almost afraid to say it. Question?
Kinda, cause I was reading the concept check question.
Mm-hmm.
So like number 2 says typically, well, 2 and 3, the basis of the assets contributed to a partnership is the same in the hands of the partnership as it was in the hands of the contributing partner.
That's true.
Okay. And then with the 50%,
So if 2 taxpayers form a partnership, each has 50% interest, each partner's outside basis must be equal.
that's false, right?
False.
Yeah, okay, I was just making sure.
Yeah. Cause, and I think we have an example on one of
Yeah.
these, like one of the earlier ones here. Alan and Alan and Bart, yeah. Cause even though they're 50-50.
Bart's was 90 and the other ones was 125.
Yeah. Yes,
Or 150, whatever.
yes,
Okay.
even though they're 50-50.
Right.
So in the example where she contributed the
Liability.
160,000 for the,
Mm-hmm.
what was it, the
Building?
building? So is the 160,000 what she paid for the building, and then it still has the $100,000 like mortgage on it, or?
No, it's whatever the basis is at the time that she contributes it. So if she was using that building, and we're assuming that she was using that building in another business, right? So she could have bought that building for $400,000, but she's had depreciation on it over the years, and now her basis in it is $160,000. So that's not necessarily what she bought it for. In fact, there's really no way for us to determine from this how much she bought it for
So it'd
originally.
just be like what it's worth to her?
It's the book value of it.
Okay, and
So-
then even though that's different than the fair market value, you always go by,
When we're talking
Basis.
about the transferring that basis from the individual, when when you're contributing to the partnership, yes. Then we're gonna go by the basis, whatever the basis was at the time that it was contributed.
so if instead of like contributing it, like the partnership like bought it from her, then would you use the fair market value, or where does that come into
Yes,
play?
so if the partnership bought it from her, so let's just say that, so the fair market value of this building is $300,000. Her basis is $160,000. If the partnership bought it from her, they're giving her $300,000, right? She's now got a gain of $140,000 that she's gonna have to recognize.
And
But
she doesn't
her-
have the liability.
And she's gonna, yeah,
But
she's
her
gonna,
personally, not for the corporation.
right, right. And you can kind of think of it in those terms, like, when you're looking at these problems, what would happen if it was a cash transaction? Right, how would that work if it was a cash transaction?
But how does service play a part in that? That's why I'm really like, what? Because what if it was what if all of them were contributing service?
Well, then they'd all have to, then we'd have to do that calculation for all of them.
So then if it was only service, then there'd be no beginning basis?
Right. Right, until those services are contributed for no income.
So when the one's basis increases because of the services, the other basis stay the same?
The other,
Like the other two partners, does their basis change as the other
No.
partners gets added?
it's all independent. The partners' bases are gonna be all independent of each other. It's going to increase though as the partnership overall earns income or sells assets at a gain, then it's gonna increase overall. And it's gonna be distributed amongst the partners.
And then that's how you can define like partner percentage.
Well, the partnership percentage is gonna be defined in the partnership agreement,
Okay,
whatever they agree to. Right, so like this first calculation here, this 240,000, the 240,000 is simply based on the fair market value of the other items that were contributed. It might not be that his services are worth $240,000, right? But it's simply a calculation of the total fair market value.
So why is his the only one that's based off of the partnership percentages for the basis?
Because because it's services and they gave us this percentage.
And he has no other basis,
Right. Right.
like he only has to offer services.
Mm-hmm. And we calculate the value of those services based on what they say, and they didn't really make that clear in here, that these were predetermined by the partners. Okay, and we can continue with this, let it sink in a little bit, okay? And read through the chat, read through the section again, okay, cause it may hopefully become clearer as we go on.
I mean, how I was picturing it is, like, say we all start a tax business, and with that, we don't, that's all service.
Mm-hmm.
So, but I'll say I have, or we split it 3 ways, evenly, 33.3,
Mm-hmm.
if it's 3 of us. We report what we've each made to our K1.
We report overall what the company made,
Well, yeah, I guess that's what I'm saying.
and then we divide that amongst our ownership percentage. And it could be that we're gonna start out with 0 basis. That's entirely possible. You can form a partnership without having any basis in it.
And yeah.
Right,
service.
so the alternative, yeah, here could be that, you know, he's gonna not, well, maybe in this case, if David doesn't start out with any partnership percentage, he's got 0, but then as he works, he increases his partnership percentage. He could do that and avoid having to pay the tax on the 240,000 all at once. But when he earns that income, he's gonna have to pay tax as he earns it.
As
Okay.
they earn it, or he, as they earn, as the company earns it.
Well, that's another way that he could, what I'm saying is if they, yes, as the company earns it, his percentage is gonna be higher, but that's because he's gonna have to pay tax on that. Right? Okay.